percent of overall EVs that ultimately are going to be used in the charging stations, what they're going to be charging per kilowatt hour. And then the important things, guys, that most of the bears will say, well, today everyone just charges at home.
The percentage of all EVs that will eventually use charging stations, the amount of money they will charge per kWh. And most importantly, bears will remark, well, today everyone just charges at home, but they charge at their office. Better than anticipated. Dan Ives, a Wedbush analyst, is spot on when he says that's possibly the best way to characterize Tesla and its stock. Furthermore, he thinks that the EV leader has more room to run following its most recent optimistic Q2 delivery figures. To put things in perspective, Tesla announced a record second quarter delivery of 466,000, surpassing the consensus projection of 447,000 on Wall Street. In a research note, I've stated that the quarter's production increased to 479,700, indicating better capacity and a healthier macro. However, they will be the only game in town when you look at it right now. For this reason, companies like Ford, GM, and others are switching to Tesla. And I believe that superchargers are in control today. Batteries will come next. And then FSD, AI kickstart thesis, Apple on the services side in due course. Musk and Tesla are only now beginning to monetize. He went on to say that the figures support the idea of a hazy background and should cause the bears to go back into hibernation. Dan Ives is undoubtedly a Tesla bull. As everyone knows, the announcement of Tesla's alliance with Ford and GM was warmly embraced. As a matter of fact, a few days ago, Tesla's stock jumped 4% to $244.50. When the company declared that it will expand its network of superchargers to General Motors electric vehicles, following a similar statement for Ford EV. For Tesla, this is a significant monetization potential. In a recent note to clients, Wedbush analyst Dan Ives increased his price objective for Tesla by 40% to $300 at that time. Where are we in the Tesla price reduction roadmap? Elon Musk is obviously shifting to prioritize growth above profitability. Yes, and I believe that was the best poker move, and it has, in my opinion, paid off handsomely, particularly in China. We believe that now 95% to 96% of such cuts are in Arabian America. Furthermore, I believe that more investors are seeing that there may have been some overreaction last week, and that there has undoubtedly been a bounce. However, margins are currently being negatively impacted at the unit cost. Now, I believe that will decline over the course of the next quarter or two before beginning to rise again in the upcoming year. And that is the yin-yang they intend to attack. However, when it comes to EVs in general, Tesla still rules the planet, and everyone else is paying rent. That seems to be getting more and more obvious. Ives referred to Tesla as a golden EV success story in a note to clients. He emphasized the expanding use of Tesla's network of superchargers and added, greater than we anticipate that other major OEMs, including Hyundai, Honda, and Acura, will follow suit. Some did, in fact. Numerous competing automakers have given up and consented to join Tesla's network of superchargers. Back in May. Ford Motor Company was the first to defy convention, and Rivian and General Motors soon followed. In quick succession, a number of other automakers, including Volvo, Polestar, Mercedes-Benz, and Nissan, embraced the trend. According to a recent report from Dan Ives of Wedbush, Tesla is set to access up to $20 billion in revenue from its new supercharger arrangements with Ford, General Motors, and several other automakers. Additionally, Tesla is attempting to secure its share of the $7.50 billion in U.S. government subsidies that are intended to expedite the construction of up to 500,000 high-speed chargers on the nation's busiest roadways. Tesla would only be qualified if other automakers were allowed access to its network. As the Biden administration has made clear, the cost of Tesla's supercharger network has been high, with each connector costing an impressive $42,000 for charging stations. Despite the associated costs, A report claims that Tesla stations are much more cost-effective than competitors, $100,000 to $250,000 per connector. Thus, the stock has increased by 10% this week. It has decreased by 10% in the past month. And the reason you see, I'm attempting to determine the link between it and the Nasdaq is because this stock will be vulnerable to that as well. Don't you think, if the Nasdaq continues to experience some issues in tech, large tech in general, pulls back? Yes, of course. Our perception of Tesla remains that of a disruptive technology business, not an auto player. Correct. However, we believe that tech stocks will soar in the second half of the year. In my opinion, the new tech bull market has already started. Growth will surpass Street's forecasts, in my opinion. That's only the appetizer powder, and I believe we were speaking with NVIDIA. It's what players in the tech ecosystem will experience in the upcoming years as a result of this ** trillion-dollar tidal wave of spend **. Tesla's network of superchargers is without a doubt the ** strongest and largest on the planet. ** and it garnered significant attention earlier this summer when it struck partnerships with various OEMs to permit their IVES to utilize the charging infrastructure beginning in spring 2024. IVES stated in a different letter to investors, greater than we modeled and projected out Tesla's supercharger network, accounting for access and revenues from other OEMs using stations around the United States. In order to delve deeper into this sum of valuation, ultimately we project that by 2030, Tesla's supercharger business will account for approximately 3% to 6% of total revenues, or ** $10 billion to $20 billion. Although the opening of the supercharger network to OEMs is a significant aspect of the Tesla story, I've stated in the note that it is just one part, suggesting that there are more. Robust production. Numbers. A flourishing energy sector. Ongoing advancements in autopilot and full self-driving technology. An unparalleled battery ecosystem, an expanded production and scale scope, all helping to ensure that Tesla's balance sheet is strong, greater than as part of the government's plan to reduce carbon emissions to zero by 2050. We believe Tesla is in a prime position to further capitalize on the EV transformation taking place, Ives wrote. In short, IVES firmly believes in Tesla. He pointed to the company's ** growing ability to bring in revenue outside of EV sales and stated that Tesla is in a massive position of strength, ** after building its EV castle and is now ready to further monetize its success. According to IVES, Tesla is expected to generate ** an additional $3 billion in new revenue from Ford and General Motors EV consumers. Ives pointed out that earlier this year, Tesla ** agreed to increase its network capacity by more than ** doubling its present capacity of approximately 5,000 superchargers to 7,500 by 2024. He predicts that its expansion will be accelerated by the growing number of agreements with other automakers. Since Tesla's network is almost exclusively powered by solar, the costs of energy generation are minimal. Consequently, IVES predicts that ** Tesla's supercharger network will represent a substantial monetization opportunity, **, and will contribute ** approximately 3% to 6% of total sales, corresponding to a $10 billion to $20 billion business by 2030. This suggests that by the end of the decade, ** Tesla's extensive business may produce total revenue of more than $330 billion, a significant rise from the $94 billion it recorded over the previous 12 months. Ives recommended Tesla stock as a buy a few weeks ago. His price target, which is among the highest on Wall Street, is ** $350 a share. This amounted to around * 73 times his projected earnings of approximately $4.80 per share in 2024. In all, 39% of analysts who follow the firm recommend buying shares. It's now experiencing its retreat, or whatever you want to call that. What do you desire? Really? These stocks will rise 60% and 70% over the course of the year. Asterisk, asterisk, in my opinion, it was much overcorrected the previous year. Well, that's what we think. And I believe that as 2024 and 2025 approach, investors are increasingly considering various a cycle that, with asterisk, asterisk grammar, clarity, and flow, improved in every word and sentence intact, asterisk, asterisk. This has now been completely edited and arranged. Do you want this transcript to run flawlessly once? I fixed the continuation.